Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Sirius's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 13 billion market cap. They're trading at $3.29 a share, and they have 3.9 billion shares outstanding. Sirius operates as an audio entertainment company. They run Sirius XM and Pandora. The Sirius XM segment provides music, sports, entertainment, comedy, talk, news, traffic, weather, as well as podcast and infotainment services on a subscription fee basis. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Pretty good free cash flow, although it's declining. It was 1.6 billion, now it's 1.2 billion. Margins also came down from 19% to 13%, but 13% is decent. We saw a lot of companies with single-digit margin. At least they have some breathing room in case a big expense rolls in. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's really steady, around 1.2 to 1.3 billion. Revenue is the sales for the company, and that's also steady, not much growth there, 8.7 billion to 8.9 billion. They do pay a nice dividend, 3.2%, and they could cover that dividend nearly 3 times with their free cash flow. Free cash flow, 1.2 billion. It cost them 400 million to pay the dividends. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $17 billion. We divide that by 3.9 billion shares. And we get a calculated stock price of $4.41. They're trading at $3.29, so they're trading at a 25% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. Simply Wall Street's close to $9. They say the stock is 63% undervalued. 12 analysts priced this stock at $3.78. They say it's undervalued a little bit. There are 42 companies in the same industry as Sirius, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 660 million, more than double the average. We can't look at their debt to equity ratio, negative equity, which means their assets are lower than their liabilities. They pay a really nice dividend, 3.2%, second highest on this list. They generate lots of free cash flow, 1.2 billion. Market cap is 13 billion, which ranks 8th. We can't look at their price to book negative equity, which means their liabilities are higher than their assets. Look at that PE below 10. They're trading at 10 times earnings, 11 times free cash flow. Really impressive numbers. And they're trading at 1.4 times revenue. They generate nearly 9 billion of revenue, a lot more than Warner Music, although a lot less than Paramount. Look at that, Paramount 29 billion. Sirius's revenue is growing. Their 5-year annual revenue growth rate is 6%. Here's their latest income statement, second quarter of 23, second quarter of 24. Subscriber revenue is down. It was 1.7 billion, now it's 1.66 billion. Advertising revenue is flat. Equipment revenue is exactly flat. Other revenue is down a little bit. So total revenue 2.2 billion. Last year 2.25 billion. Their big expense is revenue share and royalties. They have to pay to the musicians 700 million. Then they have programming and content 140 million. Customer service 100 million. Marketing 228 million. So total expenses 1.7 billion, operating income 500 million, a little higher than last year. They pay 100 million in interest. That's the interest they pay in their debt. Pre-tax income 400 million, 89 million of taxes, net income 313 million. Pretty much the same as last year. EPS 8 cents, just like last year. And their shares outstanding are almost identical to last year. So to summarize, I have them trading at a 25% discount. I rank them 7 out of 10. Would I buy it? 8 out of 10. It looks really appealing at this price. Amazing ratios, 9 out of 10. Look at that PE, below 10. Price to free cash flow, also really impressive. Financial is 5 out of 10. Revenue is flat, that's why it's only 5 out of 10. But they still generate positive free cash flow, even though they don't have a ton of revenue. So that's a good thing that they're managing expenses well. That's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.